today. So thank you so much, Saz, for joining us for this panel. First of all, we've been talking a lot about unlocking capital at this point for different sectors, the real sector, infrastructure, real estate. We're begging for patient capital at this point. I'd like to get your impression on what it would take to actually unlock funding that's for the real estate sector. What would it take, at this point? I'll start with you, sir.
Thanks for the question. I think one can look at it from the supply side and then also look at it from the demand side. From the demand side, and I've listened to some of the conversations, I've really spoken to this. It's really a question of having projects that demand the capital, projects that can be recipients of that capital. I think PENCOM, when they were here, they talked about the quality of project, they talked about bankable projects. In terms of PENCOM, I think I had them talking about projects that have got, sustainable cash flows, reliable cash flows. I think I had them talking a little bit about governance type issues. I think I had them talking about the structuring around those projects to make them bankable, whether it's closing gaps on the for example, if they are unreliable cash flows and therefore there are possible gaps using certain products, whether it's blended finance or whatever, to close those gaps. Then on the supply side, meaning that assuming there are enough of those types of projects, then what does it take to bring the capital to those projects? I think if you're talking about local currency, then there's a question of making sure you've got the capital markets, and I think PENCOM are the suspects that are looking at that. You've got the savings levels that are creating the capital that will invest in those projects. If you're talking about hard currency, that means you're talking about capital coming from abroad, then you're talking about the policy framework around that. So for example, some of the regulations or the changes that were made to the FX market have gone a long way to contributing to making it easier for hard currency flows to come into the country to fund projects. Now, for example, if you have got, an exchange rate that is not sustainable, that means anybody coming in at one exchange rate and is going to be exiting in 10 years' time, he's almost certain that he's going to be booking a loss from day one. But when you have a more reliable exchange rate, people know, there's an understanding that is driven by country macro, etc. Then the investor, the long-term investor, can factor those issues into his investment decision. If he needs to hedge it one way or the other, then he can factor it. So I think those are the two sides I would think about when you're looking at bringing a lot more capital into investment projects.
Right, and it's been great, watching the Naira stay stable, coming in from 2025, even into 2026. But, we keep talking about, public, private capital, and it almost seems at some point you feel like, the private and public somehow, work against each other. What do you think can be done to get a collaboration, between private and public capital to actually unlock these funds needed for infrastructure and the real sector?
I don't see it that way. I don't see there being a natural clash or conflict between private and public. What I would say is that most public capital, most governments are capital constrained. I mean, they have a budget, they can only raise X amount of revenues, meaning that they cannot tax you ad infinitum, isn't it? You guys are only willing to pay certain amounts in taxes, right? So the government budget is going to be limited. Their pass is limited. So there's only so much they can do. And to me, to my mind, I would argue that because public capital is always going to be constrained, then the public sector, in terms of project funding, should limit itself to doing the things that maximize the bang for their buck, okay? So they should be focusing, for example, on helping bring through projects to the market. You know, whether it's the early work that needs to be done to develop feasibility studies, to develop studies, developing the framework for those projects, because those are the things that they can do very well, you know, because the public sector includes parliament, you know, it includes the executive, you know, and all that. They can create policies that make it easier for projects to become bankable, that make the regulatory environment more reliable. You know, those are things they can do without consuming capital. And then leave the job of, you know, the actual capital to the private sector, okay? Because the private sector tends to be better able to raise huge amounts of capital. And I think there was talk about here about blended finance, closing some of the, as I alluded to earlier, the gaps that might be there, focusing on those particular areas, you know, focusing on just providing that blended finance, that component, I'm conscious that certain terms are not, you know, when we talk about subsidies, you know, everybody thinks about, you know, you go to the pump and instead of paying 100 naira or 1,000 naira per liter, you ought to be paying only 100 naira. That kind of subsidy, which is a mass subsidy, is probably not what you want to be doing. You want to be targeting certain types of subsidies or incentives that will allow projects to happen as opposed to mass subsidies. So if you think about it that way, I don't think the two are in conflict with each other. It is one working to enhance the other. So.
All right. Yeah, definitely. You know, sometimes when you hear subsidy, kind of puts a sour taste in our mouth at this point. But subsidy is not a bad thing. It's how you do it at this point. Dr. Suleiman, I'm coming to you with this one now. We know there's a gap there when it comes to finance. Tell us why it's there and how we can actually, you know, close that gap.
Okay. Thank you very much. The gap exists clearly. But I think the challenge has always been, how do you present pipelines that are investable, just like the DG mentioned earlier? And what makes pipeline investable is their bankability and how you prepare them. So a lot of the challenges we have is promoters not being able to even fund that early preparatory stage of their projects. And once you don't do that, then it's difficult for you to then attract capital, right? Capital will naturally follow where they can see clear sight of return of their investment. That's one. And how do you do this? You need to begin to, beyond preparing the project properly, also be able to match the investment to the tenure of the projects. Ebenezer mentioned data center the other time. How do you give data center money for 5 years when the cash flow is for 20 years? So the issue really is about structuring, and the problem we have, I think, is about structuring the appropriate way, using the right instruments to then support the projects once they are proving that they are bankable. So once we do that, it's very easy for us to find capital chasing these projects because there is a clear sight of return. That's on one hand. On the other hand, especially for international investors, we have issues with FX, right? And like I highlighted earlier, Christian highlighted earlier, if you deal with matching the receivables with FX, either by linking them directly with instruments that support that, like hedging, then it's very easy for you to be able to then flow investment both internationally and domestically into such projects. So I would say really the gap exists because of the way we try to finance projects, infrastructure projects, because we try to finance them like working capital, which is short term and does not sync with the cycle of those projects, or else they'll get into trouble. Then we need to prepare them properly. And finally, we need to find a way to de-risk those projects. And I think that's where the public sector plays a very big role. Things around right of way, land acquisitions, those are things that the public sector can deal with, right? Why they then leave the rest to the private sector who has the experience and capacity to mobilize funds to then take those projects forward. Thank you.
Thank you for that. Mr. Mueller, I'll come to you now. Definitely we've talked about bankable projects a lot today. For you, what would make you want to chase a project and say, you know what, take my money, at this point? What would you like to see there?
Okay, thank you. And thank you to FSDH for inviting us all to be part of this investors conference. There's really three opportunities that we're seeing in the market today, as far as one is taking existing, established, really brownfield clients that are still diamonds in the rough, have never come to the capital market, have never gotten a credit rating. It's really bringing them in to borrow at capital market rates, which are today maybe 16, 17% for a risk-free instrument versus the 28, 29% they're borrowing from banks. So that's part of what we all collectively have to be doing is shepherding these clients into the capital market. The second and the biggest opportunity remains, PPP projects, working with government, whether federal or state, and really convincing them to involve the private sector, not just as a contractor that builds and walks away with their profit, but actually as the financier, operator, 30-year operator is really the opportunity. We've done it in ports, we've done it in last mile gas infrastructure, some of the hydropower plants. We need to do it in a lot more areas, be it everything with the rail infrastructure, water projects in every urban area. This is still a massive area where there's political risk. You don't know what the next governor will do or the next DG of a federal parastatal. So you do need those political protections to enable the private sector financing to come into those projects. But the models are there, right? If you have maybe an ISPO or you have a direct agreement that protects the lenders. The third area, others have alluded to on blended finance. For socially impactful projects, there's other capital that can be blended in. A lot of foreign capital from development finance partners that used to insist on lending in foreign currency, which is the wrong model for Nigeria. But now there's a lot more willingness on their part to take local currency risk because it's impactful. And again, that's doing rural mini grids and really bringing infrastructure to people that haven't had it for the first time. So there are three very unique funding opportunities that are all available to us today. We're not facing some huge devaluation crisis or something. We must take advantage of this time. Thank you.
Right, and looking at this time, Mr. Mueller, what sectors are giving you a lot of confidence right now when it comes to the Nigerian economy?
Energy is more open than ever, really, in terms of everything in the electricity space and what we call gas to power. And I always use these examples. 10, 15 years ago, a lot of these tools didn't exist. You didn't have an InfraCredit to provide a 10, 15, or 20-year guarantee. You didn't have infrastructure funds. Now there are several taking 10-year local currency risk. Every electricity license had to come from one regulator in Abuja. Now 36 states can issue their own licenses. So all these tools are available to us. Also, liquefied natural gas. We didn't have it available in our domestic market. As much as Nigeria had been exporting it for 20 years or more, there was no availability in the domestic market, but now there is. And we just had a client commission their plant in Ogun State 2 days ago and send their first trucks up to different factories in Kano. So projects can be structured today with local regulation within a state environment. They can operate on whether it's solar or LNG, whatever is available. Again, these really weren't available to us even 10, 15 years ago. So the energy space, by and large, there's no reason why we can't actually achieve what we've always talked about, which is 20,000, 50,000, 100,000 megawatts. It's just going to be local, regional solutions, not necessarily top-down, but bottom-up solutions.
Well, thank you so much for all that, Mr. Oyewale. Now, so definitely we've talked a lot about locking capital for different sectors, but the real sector at this point that definitely needs a lot of attention. What do you think can be done, for those players in the real sector? How should they position themselves to actually, attract this capital that they desperately need?
Thank you very much. I think for the real sector, just like the DG Pencom mentioned, we aren't seeing a lot of bankable projects. and we need them. Okay, and what makes a project to be bankable? I mean, you have to have clear feasibility studies being done. You have to have very clear sight of the revenue streams, and you have to be able to mitigate the risks. Now, those three points are usually, you can expand them as you want, because when you talking about risk mitigation, one of the key areas is what is government doing to reduce the risk of that project? Is there policy consistency? Is there a challenge with the foreign exchange? Is there a challenge with the macros generally? Okay, then you need to speak to the revenue streams. Do you have very, very solid offtake agreements, for the next 5 years, next 10 years, in order to make investors to be willing to actually come over and help you? Do you have proper structures for the project you are trying to do as well? I mean, just like Mr. Mueller mentioned, there are many different ways of structuring a project in the infra space. You can decide you want just DFI, you want local financing, pension funds, getting GCC funding. But what is the ideal structure for the kind of infra you are trying to build in that your particular project? You must get a proper financial advisor. Then also there's usually this concern by promoters. They do not either put in enough equity at the initial stage, or they don't appoint the right financial advisors. They think they can do it, they just meet A, B, C, D. So if you can address those concerns, have a very, very solid feasibility studies being carried out, E&S studies being done to be sure there are not going to be environmental pollution as a result of your project, and ensure that you have revenue streams that can be stress tested, whether there are vagaries of the economy, will this project still be solid? Then also ensuring that the risk areas are identified and mitigated. Then you get proper funding coming for your project.
But, looking at what's playing out, in the global economy and, locally, is there a risk that, most of these fund managers, is there a risk they miss out on the big picture, because they're trying to, secure that fund and, not looking deeper, into that, project? Do you see that happening sometimes?
Well, it will happen occasionally. I mean, you'll be some gems, depending on your screening methodology, depending on the strategy of your fund as well. You can miss one or two gems. But any fund manager is usually how to optimize their returns. However, it's within certain boundaries. A pension fund manager, for example, has to comply with all the regulations of PENCOM. A fund manager that has an infra fund that's given prospectus to SEC has to comply with whatever they have said their investment committee will review. So they may have sectoral limitations, they may have currency limitation, geographical limitations. So all of these have to be brought to bear before they can decide whether to support a project or not. But at the end of the day, I mean, if you are squarely, situated within the ambit of the strategy of that fund manager and your bankability is assured, there's really no reason why they will not support you. Yeah.
All right, so I'll come to Mr. Mulamula now. Definitely we've heard comments, that Africa sits on a lot of money, but they're stuck in safe assets at this point. And if we could mobilize that capital to actually, plug some of these gaps. Sometimes we don't really have to go out there to, get some of these loans. For you, what should be the mindset, at this point going forward for the continent to actually use this capital well instead of, racking up debt?
Yeah, I think I had a comment, I think it was PENCOM, or I think one of us has mentioned here about the importance of developing our, local capital markets, isn't it? So that we can be able to lend to our projects in local currency. And if you look at countries like China several years back, they were probably where we are today, but really they built their reserve out of growing their savings, okay? And it's out of growing your savings, through pensions or other instruments that you're now able to turn those savings into investments into your infrastructure. So I think that's where it really it begins, by us, as Nigeria and as Africans as a whole, growing our savings. And it's a state of mind. And it also it translates into practical actions, meaning that you ought to be consuming less than you're earning. That's the meaning of the word savings, isn't it? So we have to develop that culture whereby we are setting aside our savings, we're growing our pensions, and putting that money into vehicles whereby it'll serve us, it'll work for us, but it eventually comes back to us, because what is saving? Saving is postponing consumption, isn't it? So you're avoiding consumption today, using the money that you've saved to do a whole bunch of stuff, but you will still be able to consume it later. So I think that's where the focus is. And until we're able to do that, we will continue to have weak capital markets, both on the debt side and on the equity side. It'll be local companies will be talking about New York listings or London listings in order to raise capital, as opposed to Lagos listings or Johannesburg listings or Nairobi listings. On the debt side, we'll be talking about maybe DFI funding, or for example, or funding from international banks, as opposed to funding from local banks. Why? Because we'll be saying that when we go to our local bank, they can only give us 12-month facilities. They cannot give us 10-year money. Why? Because they don't have 10-year deposits, okay? They cannot give you 10-year money if they don't have 10-year deposits. So I think that's where it starts. Sometimes when we talk of development, development is a complex subject, right? Otherwise we'd have cracked this thing long time ago. It's a complex subject, and it starts by those small things, and they build up and they rack up before they begin to yield some benefits from us.
Thank you so much for that. I'll come to Ms. Oyewale now. There was a time we're always talking about, Sukuk and the oversubscription. Most of 2025, a lot of conversations, about that. But it seems like it's gone a little quiet. I don't know if that's just me. What are you seeing when it comes to, Sukuk funding?
Okay, thank you very much. So Sukuk is non-interest finance for long-term transactions. And the poster child has been the federal government issuances, of about $1 trillion now over the last seven or so years. Federal government has been the largest player in that market in Nigeria, unfortunately, and each time they come in, they get oversubscribed. We've not seen a lot of corporates coming into that space, and they should be coming in. What we're experiencing right now is that we're seeing a lot of corporate trying to tap into the short end of the non-interest commercial paper market. So we are seeing a number of organizations. PayAza, that was here, just launched the 50 billion issuance just today. We had another entity that launched a 100 billion just 2 weeks ago, John Vance. So we are seeing a number of corporates coming in to tap the non-interest finance, but on the short end of so just to make sure they're able to handle their working capital, handle some small acquisitions. So that is going on. But for infrastructure funds, I think is an area that they should look at. Okay, there is a large pool of non-interest funds available. Maybe not so much in pensions right now, but still large. But offshore, we have a lot of focused investors that are looking for non-interest investment on the longer term. So I will urge a lot of infra funds, and we have a couple in the room here. They should look at opportunities of structuring a bankable project using non-interest finance.
All right, let me come to Dr. Ibrahim now. I'd like to get because I know you have a background in debt, at this point. I'd like you to, add some comments to that.
Okay, interesting. Thank you for that feedback, Dr. Oyewale. I think that why we are here, really, is to be able to then provide this opportunity for us to crowd investment into infrastructure. And that's why we're a debt fund. And what that affords infrastructure is really that will provide long-term capital, right? And like Christian said earlier, if we then find a way to mobilize our savings, right, into investment into infrastructure. Because most of the infrastructure that we invest in are defensive, right? There will always be that return on that investment, preserving the capital, and also even appreciating the capital, and most are even beating inflation. So always ahead, and that's what we try to do. But for us to be able to get to that point, it still goes back to the same point around what are the quality of these projects, right? Are we able to de-risk them? And that's where InfraCredit comes into the room, whereby they turn what typically would be risk into investable risk assets, right? Then how do we manage issues around policy somersaults? Like you mentioned earlier, I think that in the last 2 years or 18 months, there has been some consistency in the FS space when it comes to our policies, and that bodes well for investment in infrastructure. And if we take that forward, it's natural that our infrastructure projects would then attract the kind of capital they are looking for longer term projects. Then, of course, things around discipline when it comes to governance, right? Because the PFAs are not afraid to actually invest, but what they are afraid of is, in another 10 years, if somebody calls you up after you're retired, come and defend the investment you made 10 years ago, are you justified making them? And that is what all of us try to do. So I'm saving my money because I think that in 10 years' time, when I need, I should be able to call on it. If we don't have that in place, then it's a challenge. And that's what we need to focus on. And that's where an infra fund like ours is in the room, to provide that kind of comfort, the risk projects, ensure that they are well prepared, invest in them, and then ensure that we're able to get returns from them.
All right. So, Mr. Mueller, at this point, there's politics everywhere. But it almost seems like on the African continent, especially with some countries in Africa, they take politics to a whole new level. How much of that is the reason why some of these African countries have huge gaps? How much of politics is the cause of that, in your opinion?
Yeah, when power is too centralized, you tend to have short-term thinking. Nobody wants to build a palm plantation because it will take 5 years before you really start making money. Nobody wants to build a hydropower plant because it might take 2.5 years before it's commissioned. So you end up with a lot of people in government that have the ability to structure and fund impactful infrastructure, but they're not interested. They want to see what can be done in the next 9 months, 12 months before the next election, whether it's because they need to show that they've achieved something, or they are doing other things with the recycling of monies that go in and out of government and refund election campaigns. So that's the risk with countries that haven't well established their infrastructure yet. They haven't well established their capital markets. Nigeria's sort of caught in between. Our capital market is wonderful. Government's issuing, treasury bonds up to 30 years as a history. State governments have been issuing bonds since the 70s. We privatized the pensions in 2004. So Nigeria has the ability to fund on the private side that a lot of sub-Saharan African countries don't have. But our infrastructure is still not anywhere where it needs to be. We're still a DIY economy with your own generator, your own borehole, and the like. So we have to use these tools. Again, it's part of what the opportunity is. But that's the challenge. You try to engage with government, and they don't want to hear about a 3-year project. They don't want to hear about, because it doesn't meet their timeline. So that's the challenge, and not just Nigeria, but speaking to most elected officials anywhere. And that's why, again, we want to get as much infrastructure as we can to be privately managed, 30-year concessions. It works, it's proven. We've seen it with Mainstream and North-South Power taking over some of the hydro dams and doing a better job than when it was run previously. So that opportunity is still very much in front of us, but it takes a lot of effort to get government to agree the structures. Thank you.
Would you say politics is 80% the problem?
In terms of trying to do PPP, yes, it's maybe not problem, but challenge. It's both the challenge and the opportunity. Because if you can get the government to bid out a concession for a project, transparently done. If you actually have the connections and influence and pedigree to make that happen, well, you'll just be doing project after project after project in this space. So again, that's the opportunity. We worked with Ekiti State last year. It's actually 4 years we worked with them. They rewrote their PPP law. We crowded in some foreign technical assistance to fund technical studies, and they bid out a project for a toll road, 17 kilometers. The SEC approved the 20-year bond by the concessionaire, and we guaranteed it. So it can be done, but we have to then emulate that, copy that model in other states. And pension funds bought that debt on the back of our guarantee. So this is, again, it took several years to do it. That doesn't always sound like it's worth the time for everyone, right? But the model's there. It's about replicating it. Thank you.
You want to jump
Yeah,
in?
I want to quickly jump in defense of Africa on this one. So yes, are there political challenges in Africa? But I mean, I'm not sure if there are enough people older than me in this room, but I still remember the days in Latin America where there were sovereign defaults literally every other day. Countries like Brazil and Argentina had inflation running at 4 digits. Literally, you go in the morning to buy something at $1. When you come back in the evening, it's $100, literally in one single day. So these challenges are not necessarily unique to Africa, right? And that's not to exonerate Africa. But, Latin America has gone through them. Latin America has probably come a long way, in more recent times, you're beginning to see it a lot more settled. You're beginning to see a lot more public-private partnerships coming through in Latin America. I think they learned their lesson, isn't it? Because of the limited physical space, because of the difficult macro environment, governments were forced to make some really tough decisions. And that's sometimes what it takes. I suspect many Nigerians will agree with me that the policy reform that was taken after the last election was one of the toughest decisions that the government had to take. But it found itself in a very difficult place. The proverbial hard place under a rock or something. I think that's what the Englishmen say. Yeah. So sometimes that's what it takes. And I think that's what you're calling politics. And sometimes you need really to get to that place when you're now willing to do, as Daniel has said, you're willing to parcel out certain areas of your business as a government and say, this one, I'm going to allow the private sector to run with this one. Whether it's a highway, whether it's an airport, whether it's a bridge. And then you say as a government, I'm going to focus on this. I'm going to focus on getting the kids a good education, making sure they have malaria vaccine, and all that sort of stuff, the softer side of the business.
Thank you so much for that. So, Dr. Ibrahim, what would improvement look like for you, when it comes to, bridging these gaps? We're looking maybe 10 years out.
Very simple. I think that we need to find a way as a country to create a pipeline of bankable opportunities. And what that really means is that we should find a way to fund projects that have impacts and scale and prepare them for capital flow into them. That would be one. The second one would then be that we need more of InfraCredits in this market where they can provide guarantees, either partial or full guarantees, to then allow people that typically, or investors that typically will have some sort of fears around those investments, then be able to then invest in them because those guarantees have been given. And once the project is well prepared, it's very easy for you to then implement and start making money from them. And they won't lose, the investors won't lose. And we have the infrastructure that we're looking for. Those two will be real, because I think the policy environment is becoming consistent. Gone are the days where we have flip-flops, right? So I would think that is less of a concern. But having investable pipeline of projects, critical projects, and the InfraCredits of this world to be able to then guarantee investments.
And I guess another fear is you see stable policies with one government, then you have that fear. If that government goes out, then things change again, and you start from ground zero.
So you referenced that earlier when you talked about the fact that you have the right set of advisors. And I'm very happy to chip into this. When we did MME2 transaction, we have maybe all the advisors coming from abroad. Today, we have more than enough certified PPP professionals that are also now advising other countries on the continent. I'm one of them. So we've learned over time, right? Over time to then be able to lean on that, to be able to then support transactions. That's on one hand. And I hear you, it's possible, but when the government knows that when they default on transactions, the recourse is more than the cost of the project. Sometimes I think that they probably will just allow that project to run its course. But again, in the final analysis, if we keep flip-flopping, right, then we'll never get to close the gap that we're looking at closing. And I think because we are all learning about how to manage this sector of our economy, the likelihood is that if the project has impact, it has scale, it will be difficult for anybody to come and say, I'm revoking this. We saw that with the oil and gas sector when Obasanjo left. If we had left those two refineries, for instance, maybe perhaps we have more of those than just this one that we now have now. And I dare say that some of the capital projects that we're also seeing today, capital infrastructure projects that we're also seeing today, it will be difficult for anybody to come and say they want to revoke them because we can see the impact already. So I think that the danger is there, but it's significantly diminished from my own analysis at this time.
All right, I'm definitely hoping for a time where you see government embarking on projects and we see Nigerians actually celebrating those projects. I'm looking forward to that time. But at this time now, let's see if we can take some questions. Do we have questions? Any questions for this incredible panel? All right, have a gentleman over there. Mike's coming to you right now, so you just introduce yourself and tell us who you're directing your question to.
Good afternoon, everyone, and I'm very grateful to FSDH for organizing a session like this and to the panelists that have all spoken. My question is not to one particular person. Is actually something that borders on an intuition, sort of. So I'm thinking that instead of we to focus on trying to do more of guarantees are good, but instead of us doing a sort of like guarantees and all, can the government step in to make sure that the basic things like food, shelter, and clothing are, they provide that better guarantee for the citizen? And where I'm going is, in the advanced world, we see that somebody just starts a job now, and with that job that he starts, that he has just started, he can get housing for 30 years, can get a car based on just the employment letter, and can pay over a very long period of time. For me, I feel that frees up capital. So the citizens are able to now save for a longer period of time because they now have more cash flow that if those cash flow are not being fed into the payment of housing and into the payment of maybe the car allowance and all that. So basically, the government is doing more to make sure that the basic amenities of life, the citizens can afford it. So whatever it is that comes as spare from the citizen will be able to stimulate more savings and help the economy a bit more better. So I feel if the government can step in that regard, even doing a lot of guaranteeing a lot of infrastructural projects and all that would not seem like more of a necessity for us to be able to go over and above whatever limitation that we're experiencing right now. So I feel the government should be able to step in and do that. And if the government steps in, the citizen will be encouraged to save more and then to translate to more investments and the growth for the nation. So that is just an idea, and I feel I should just let it out. Thank you.
So we're getting a statement right there from him and an idea at this point. If anybody wants to jump on that idea, do we have any questions? Okay. All right. So, what do you think about his recommendation?
Maybe I'll start. Look, I think it depends on your philosophy about life as to whether you think money is best placed in the public sector or better placed in the private sector. Because remember, for the government to do anything for you, it has to get the money from you. Okay? That's the way it works, isn't it? The government has got to tax you in order to be able to come and do things for you. So it has to be, is your posture that I'm better off giving my wallet to the government and then it does a whole bunch of things for me, or would I rather give as little as I am willing to the government, and then the rest of it, I am the custodian of what I do with the rest of my money, okay? And that's what most people in capitalism tend to think, isn't it? They want to minimize their taxes. Of course, you're obeying, you're following the law and all that, but they want to minimize their taxes and then allow enough for themselves to now figure out what they are going to do with that money, that disposable income. I think that's what the economists call it, disposable income. Then they can figure some of it they might save. Now, in fact, when you talk about countries whereby you can get a job and you can buy a car and on 10-year money, it actually means that sometime back prior to you, somebody had saved that money so that somebody can come and lend it to you for 10 years. Because you haven't earned it yet, okay? So anybody lending you a 30-year mortgage, because you haven't earned 30-year money yet. Somebody else earned 30-year money. He has saved it. He has postponed his consumption so that you can come and borrow it and pay it over 10 years. So it really depends on your philosophy about life.
Fantastic. All right. I guess that's a good place to anchor it at this point. Thank you so much. Please put your hands together for this incredible panel. Thank you.